This is a critical update ahead of tomorrow's jobs report. As Kurt on X here says, he is the founder of Ivory Hill Wealth, pension and 401k advisor, says that this Friday's jobs report is the most important jobs report of your life. So read this thread, and that's exactly what we're going to do in this video. I will share with you what markets are expecting for the jobs report, for the headline job ad number, as well as the unemployment rate, what could be a good outcome or what could be a bad outcome, and ultimately what you want to see happen, which is 10-year treasury yields that come down. This could be a make or break it moment for our markets because everything is so weak right now. 66% of stocks are in an active decline. You haven't had this many stocks on the S&P below their 200-day moving average in 18 months. I mean, that's a really bad setup heading into this critical jobs report. As well as that, I will explain 6 main things for 2025 that I think will happen that Wall Street is really not expecting that will drive the markets higher this year, okay? And I know if you're a bear, you don't even want to hear this, but if you're a bear, you need to hear this even more than the bulls because you should be taking in different perspectives and ultimately coming to a conclusion. But we're going to reverse engineer these 6 things. Number 1, inflation is not an issue. The Fed will be cutting more. Number 2, bond yields will plummet. Number 3, tariffs will not be as bad as feared. 4, earnings will meet expectations generally, but broaden out. Number 5, Trump doesn't want to ruin the bull market. And number 6, the pendulum has swung too far to the bear side. For the first time in I don't even know how long, the AI Investor Sentiment Survey now has more bearish investors than bullish investors by about 3%, which almost never happens during a bull market. Work is cut out for us here in this video. Ladies and gentlemen, we are going to start this off with the jobs report coming out tomorrow morning because this is the most pressing thing that's going to be affecting markets. Soloway on X says Bitcoin continues to hammer on the 62,000 support range. Very likely the make or break factor will be the non-farm payrolls report tomorrow. Forecasts are for 164,000 jobs created. Market wants a slightly weaker number as yields are the top concern. So it's actually pretty interesting that expectations for tomorrow's jobs report are only 164,000 jobs, which is not like super strong. It's not weak by any stretch of the imagination. The long-term kind of average is around 140,000 jobs. So it's a little bit better than that. But I think a lot of the move higher in 10-year treasury yields is inflation expectations and what people are pricing in for inflation over the coming years. And that's what's driving 10-year treasury yields higher. That is an issue. You would think with 4.67% 10-year treasury yields that we're coming in with over 350,000 jobs a month for like 2 or 3 months now. And that's really not what has been happening. Now, the tricky part about tomorrow is there is a weak number and then there is a recession number. Okay, a weak number would be like 140,000, 130,000, maybe 120,000, as low as maybe 100,000. A recessionary number would be less than 100,000. Less than 100,000, it's like, is that really good news for the markets? Is that something that we should be bullish on? Should stocks rip higher on a 90,000 jobs number? Probably not. I don't think that helps the bull thesis for 2025. A slightly weaker than expected number, 130, 135,000 jobs, may help the bull thesis a little bit that the economy is holding up, but maybe there's not going to be as much inflationary kind of prospects from the labor market. We know Jerome Powell says the labor market's not a source of concern, but you're kind of on a slippery slope when you start to get close to 100,000 job ads, and that may change the Fed's tone a little bit to more of the dovish side. And I think the big negative would likely be if jobs come in over 200,000 again, then Wall Street's going to say, what the hell? The Fed, doesn't need to cut rates at all. And there's going to be people talking about even raising rates again, which I think would be a massive mistake. I think the Fed's making a big mistake now, switching kind of to the hawkish side because of what could happen via Trump tariffs and not, actual data or forecasting. It's basically saying, oh yeah, if Trump does this, inflation's going to go higher and be stickier. And well, we're going to wait and see. We're not going to do anything. We're going to hawk you down because that could happen. Now, the unemployment rate will be coming out tomorrow as well. As I explained in the last video, the unemployment rate today is 4.25%. The cycle high is 4.27%. So it looks likely we're going to break above that. Now, these estimates are rounded. So the rounded estimate is 4.30. So that's really anywhere between 4.25% and 4.34%. Okay, because you're rounded. So you could come in at a high 4.3, which would be like a 4.34%, and it gets rounded down. Or you could come in at like where we are today at 4.25 or 4.26 and still get rounded up to 4.3, which would again be a kind of low 4.3. So it'll be interesting to see how the markets react to that. If we don't get much change there, then I think it's going to be really about the headline payroll number. Kurt over here says, number one, why Friday's jobs report matters. This report could confirm or dispel fears that the Fed will pause rate cuts in 2025. The stakes are high. Here's how different outcomes might move the markets. Number two, the context. After the December FOMC hinted at ending rate cuts in 2025, stronger than expected data created fears of a pause. This shift has pressured stocks, driving the SPX lower since December highs. Number three, why the jobs report is crucial. Rate cuts drove the 2024 rally. If the Fed pauses, it creates a headwind for equities. While no rate cut is expected at January's meeting, this report could shape the Fed's tone on future policy. Number four, the market scenarios. Let's break it down into three potential outcomes. Too hot, the Fed pause, fears rise. Just right, cuts in 2025 still likely. Too cold, growth fears emerge. That's kind of what I'm explaining. Too cold, growth scare. Too hot, no cuts. Okay, just right, cuts in 2025 still likely. I think that pretty well sums it up. Scenario number one is too hot. 200,000 plus job ads, unemployment rate at 4.1%. Likely reaction, stocks drop over 1%. Treasury yields jump towards 5%, pressuring equities. And that's a bad kind of outcome. The too hot scenario continued. 10-year Treasury yields surge towards 5%. Dollar index rallies 1%, approaching 110. Gold drops sharply on a stronger dollar. And scenario two is just right. 50,000 to 200,000 job ads. 50,000. Okay, that's lower than what I would expect as just right. Unemployment rate 4.1 to 4.3%, wages below 4%. Likely reaction, a modest relief rally across all indexes, small caps and Nasdaq lead the gains. Yields drop 10 basis points, dollar weakens slightly. Just right continued, most sectors rise, led by tech, financials, and cyclicals. Defensive sectors post decent gains too. Number three is too cold. Negative 50 or below 50,000 job ads, unemployment above 4.3%. Initial rally on bad news equals rate cuts. Growth fears follow, pressuring cyclicals, materials, industrials, financials. Defensive sectors outperform and may even gain. The too cold continuing, 10-year Treasury yields drop sharply, nearing 4.5%. Dollar falls about 1%. Gold rallies hard on a weaker dollar. Cyclicals lag, while defensive may cushion broader market losses. Bottom line, the biggest risk is a too hot report, pushing yields to 5% and intensifying the sell-off. The best case outcome, a Goldilocks number between 100 and 125,000 job ads. That calms Fed pause fears and sparks a relief rally. Brace for Friday, markets are on edge. I actually think anything below 100,000 job ads is going to be seen as a little bit on the weaker side. And I generally agree with that, though. If we come in at like 50,000 jobs, markets probably do get some kind of relief rally on the whole bad news is good news thing. but that is not a relief rally that will last. Okay, so if we're thinking about the longevity of things, you do not want a too cold of a number because you got to always revert back to basic principles. What is the basic principle? No matter if the Fed raises rates, cuts rates, pauses, tariffs, blah, blah, blah. Basic principles always revert back to profitability and EPS. A labor market slowing down, one would say, contracting, right? If we get a 50,000 jobs number, people are going to expect the labor market's going to start contracting in the coming months. That's not going to be good for profitability. That's not going to be good for earnings. So it would be more like a tactical bounce on that, but it would then follow a more severe sell-off than even a too hot jobs report. To some extent, Wall Street will be able to kind of get over a too hot of a jobs report eventually. We get CPI that comes out next week. If CPI comes in on the light side, all of a sudden, 200,000 plus jobs is a good thing because it doesn't matter if inflation's coming down. I think a lot of people have forgotten we can have a strong labor market and a strong economy with inflation falling. That is possible. We've seen that over the last 15 years. Now, tomorrow morning, we will also get Michigan consumer sentiment, but if we get a big surprise in either direction for jobs or the unemployment rate, but really the combination of both, I don't think markets are going to react too much to Michigan consumer sentiment, but if we get a Goldilocks report, then we will react to this more. Hopefully, if that makes sense. Michigan consumer sentiment headline number is expected at 75. Last month was at 74, so you are expecting an increase. Five-year inflation expectations are expected to rip higher from 3% to 3.2%, which is a big jump on a month-over-month basis here. Consumer expectations are expected to tick upwards from 73.3 to 74. Current conditions are expected to go up from 75.1 to 78. And one-year inflation expectations are expected to go up from 2.8% to 3%. Okay, look at those expectations for inflation expectations. 1 year ahead's expected to go up 0.2%. 5-year inflation expectations are expected to go up 0.2%. I mean, that's what is part of the rally in treasury yields that we are seeing right now is everyone's starting to expect higher inflation, which I don't think that is at all a certainty in this year. Now, we did have a couple of Fed speakers today, Fed Harker, Fed Barkin, Fed Schmidt, and Fed Bowman. Let's take a look at some of those headliner quotes that came out. Fed Collins says the job market unlikely to be a driver of inflation right now. And she said, I am less worried about labor market fragility with the current outlook that calls for gradual, patient approach to rate cuts. She says, I supported the December Fed rate cut, but it was a close call. And she says, housing factors still a major driver of inflation. Now, what I found interesting about that is the last 2 months, you've actually seen housing inflation coming down on a month-over-month basis. If that continues or picks up speed to the downside, then inflation could very easily surprise to the downside, and then all of these fears of inflation are unwarranted. Fed Collins says, it's too early to say what impact the election will have on the economy. And she says, I now expect more inflation relative to the recent path. And the economy is on a gradual, uneven trajectory back to 2% inflation. She says the economy is in a good place overall with notable uncertainties, and the current outlook is in line with the Fed December forecast. Fed Harker says U.S. central bank still on rate cut path, future moves driven by data. Fed Harker says labor markets stabilized, are in a better place, and he says the underpinnings of the economy are strong amid high uncertainty. More of overall consumer spending is resting on higher incomes. As well as that, he says it's taking longer to get back to 2% inflation than expected. And Fed Harker says the Fed must remain data dependent and not act with haste. It'll be interesting to kind of see these comments versus the jobs report that comes out tomorrow, because Jerome Powell says Fed officials get important jobs numbers or inflation data a day or two before they are released to the public. So this sounds kind of like the jobs report's going to be a little on the hot side tomorrow, just kind of the tone of language they're taking. But then again, that's not, a certainty. Fed Harker says it's unclear what longer run path of Fed rate target is. And Fed Harker says, I don't see the Fed changing rate control toolkit anytime soon. Like, they're not going to adjust to a 3% inflation target anytime soon. Now, in terms of actually re-engineering my outlook for 2025, number one, I say inflation is not an issue. The Fed will be cutting more. I'm not seeing inflation in everyday living like you've seen in 2021. Even at the start of 2021, it was like easy to see inflation coming because prices were starting to rise before the data actually picked that up. That's not happening right now. And I think the effects of lower oil, deregulation, are going to be a lot more disinflationary than people expect. And this kind of goes along with number two, bond yields will plummet and tariffs will not be as bad as feared. The main thing right now, the main reason why everyone expects inflation's gonna move higher in 2025 has nothing to do with things that are actually taking place right now. Okay? The only thing that has people concerned about inflation is tariffs. And we don't know what those are going to look like. Okay, so take tariffs out of the equation. Let's assume tariffs are net neutral at best. And tariffs really are a one-time price jump, not necessarily inflationary. Or it doesn't necessarily create like a longer-term inflationary effect. It can create like a 1 month, 2 month jump in inflation, but it doesn't tend to continue to lead to a rising inflationary environment because it's a one-time jump. Okay, but I mean, assuming we don't know what tariffs are going to look like, the assumption that Wall Street has of all of this crazy inflation that could start in 2025, I've heard people say inflation is going to go back to 4%, right? Go back to 3.5% on a year-over-year basis. I don't see anything to justify that. Even more so when we look at the data that just came out yesterday, in fact, the credit card data just plummeted. Okay, that is very much not in line with a thesis of higher inflation, right? You actually got deflation back during the Rona drop for obviously a brief period when the last time credit card debt went this negative. You were not struggling with inflation during this time. I don't think you're going to struggle with inflation. Like, this, I think, is a pretty telltale, obvious sign that we're not going to struggle with inflation in 2025. So I think that's really bullish for markets because we're so swung to one side of the podium. Everyone's in the higher inflation camp. Everyone's in the, Fed's not going to be cutting rates as much as expected camp. What happens if we do come in with 100,000 jobs tomorrow or 90,000 jobs tomorrow? Next week's CPI report is really low. What do you think happens then? You're going to flip the whole narrative on its head. I don't know if that's going to happen, that fast, right? Tomorrow and next week, kind of change the whole narrative for 2025. But especially as we get deeper into Q1, into Q2, I think it's going to become obvious Wall Street got way too negative on tariffs and what that'll do for inflation and even on how strong the economy is going to be. I think earnings are going to be fine this year. I think the economy is going to do okay, but it's not going to be as hot as people think. We're not going to be tracking at 3% GDP this year. I don't think so. So, there's going to come this moment where growth is surprising to the downside. Inflation is surprising to the downside. That will force the Fed to cut rates more than expected. Even consider what Trump said 2 days ago. He said that interest rates are far too high. Not too high, but far too high. And everyone thinks that's why Christopher Waller from the Federal Reserve is kind of taking the more dovish approach here, getting ready to take over for Jerome Powell when Jerome Powell's term is over. Now, number 4 here, because we kind of just discussed 1, 2, and 3, bond yields will plummet, tariffs will not be as bad as feared. And that bond yields kind of goes alongside that, right? bond yields are going to come down with weaker economic data and with lower inflationary data. That's what's going to drive down those bond yields. So we covered 1, 2, and 3. Number 4 is earnings will meet expectations generally, but broaden out. So I think consensus is pretty right on earnings. I don't think we're going to have a big downside disaster for 2025 earnings based on current expectations. We're expecting around 10, 11, 12% earnings growth for the S&P this year. I think that is very doable. You could actually come in a little bit higher than that if estimates tend to fall throughout the year, and then you normally beat on earnings expectations, okay? So I don't think that's too crazy, but I do think it will spread out from not just big tech, that was like 80% of the earnings growth last year, to like big tech's going to be like 35-40% of the earnings growth this year, whereas the rest of the markets will start to accelerate in their earnings growth, and that will help really that broadening out. Now, number 5 is my opinion. This is solely my opinion. But Trump doesn't want to ruin the bull market. So people that are fearful about inflation, about tariffs, and all of the negative side of Trump policies, I think people really forget that Trump's got a lot of rich friends. We'll call it for what it is. He doesn't want to lose them a lot of money. He doesn't want to, ruin the bull market, leave a scar on his legacy. So he can only do so much to the extent of it causes markets to sell off. If markets sell off too much, little sell off, not an issue, but too much, and you're going to get a sharp shift in the policy kind of path from Trump. Okay, I think most importantly, above all else, is not destroying his reputation, not being the business-friendly guy that came into office and destroyed the business cycle. How ironic would that be? Everyone thinks Trump's pro-business and pro-lower taxes and faster growth and capitalism, and he comes in and just is a freaking tsunami on the whole thing. I don't think that's what Trump wants to kind of leave as his legacy here. Wins a second term, almost gets assassinated, and boom, took out everyone's shit. No, okay? So, tariffs sound bad and blah, blah, blah. It's testing the waters. It's seeing what you can get away with. So at this point, a 10% blanket tariff, I don't think would be inflationary. I think the markets are prepared for a lot more than that. So I think it wouldn't be inflationary. And I think it would be by the news situation. I think it would be, oh, wow, 10%, that ain't bad. We can live with that. People start modeling that out and they say, maybe we're too bearish for only a 10% blanket tariff. The issue then again would be if we start a trade war with China or with Europe, but most importantly, China. And, while that's still up in the air, Trump invited the Chinese President Xi, to his inauguration. Okay, I don't think you invite the guy that you're going into a trade war with, presumably, if we slap tariffs on China that are too big, to your inauguration. Okay, I don't know. That's just me. I'm not going to invite, I don't have any enemies, but I wouldn't invite my enemy to my wedding, okay? I wouldn't do it. Maybe that's just me. Maybe Trump's, got something else planned there, but doesn't sound like it's going to be a bad relationship to me. And then number 6 is generally, again, the pendulum has just swung too far to the bear side. You're way too bearish right now, and you shouldn't be, I guess I should say. Yes, valuations are high. They were a lot higher. They've come down a bit. If you're looking at the internals of our markets, there is some stocks with very low valuations trading with big discounts. You look at something like, I know, a Dollar General, right? They've had their own issues, but tariffs are a big thing that's affecting them right now. Tariff fears, right? There's a lot of stocks that are trading on potential tariff fears, and we don't even know what that's going to look like. There's a lot of stocks trading lower recently, including small caps, based on, 10-year treasury yields. 10-year treasury yields are moving because we expect things to happen, like our expectations ever are actual reality. Let me tell you right now, if we're expecting tariffs are going to cause inflation, we're either going to see tariffs with no inflation, no tariffs, or we're going to see hyperinflation with aggressive tariffs. Like, consensus is rarely ever correct in markets. So it's either going to be way worse than we think, or it's going to be way better than we think. I'll go with the under, not the over. I think it's going to be a lot better than we're fearing versus a lot worse than we're fearing. So that's why I do think this is a buying opportunity right now. I do think there can be more volatility, obviously, into the inauguration, January 20th. I think that's where things could get real for markets. If we sell off into then, you probably get a buy the news kind of event with Trump actually taking office. But once we start to hear more headlines about, tariffs and what the actual policies could be, then, depending on what the number is, that could that could be kind of the driving factor of markets at that point. But as far as tomorrow, it is all about the jobs report. I think you're set up well to not get a super low jobs report, but not get a super high jobs report, probably a Goldilocks report. And then the real big catalyst, like the thing that matters the most, is CPI. Because if inflation's coming down, if we surprise to the downside, then who gives a crap what the jobs report is? Inflation's falling. So these are my expectations, and I make this video that is so critical, that you guys watch this in pretty rapid time. You only have 24 hours until, less than that, 20 hours until the jobs report comes out or so. And this is going to move Tesla a lot. I mean, let's face it. It's going to move 10-year treasury yields a lot. It's going to move your interest rate sensitive stocks the most. I wouldn't be surprised if Tesla has a 7% positive day or 7% down day coming tomorrow. Again, I would take the 7% up day versus the 7% down day, but it's still a risk nonetheless that you need to be prepared for. So, ladies and gentlemen, let me know what you guys think about this information down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.